Mark, I'm seeing in the press recently a lot of activity in the investment and wealth platform space. What are you seeing in the market on the ground?
Yeah, there's definitely a lot of activity at the moment in the platform sector, Martin. And whilst the wider macroeconomics have seen M&A slow down, generally the sectors remain relatively resilient, albeit perhaps with slightly reduced multiples at the moment. And I think as the market picks up, we'll definitely see activity continue to happen through the sector. And I think it's driven probably by a range of factors. You've got increased digitalisation and customer expectation. You've probably got increased competition and consequently a narrowing of margins. Possibly off the back of that, a slight reduction in the ability to grow organically. And you've also got things like consumer duty and greater regulatory scrutiny. And all of these things are driving M&A activity as operators look to accelerate that digital transformation, enhance their offering, and also benefit from economies of scale. Also seeing, I think, a number of operators who are refining their business model and disposing of non-core assets. So all of that lends itself to continued activity, and that's probably going to be across a mix of smaller transactions as people consolidate and look to add complementary verticals into their model. And also, I suspect some of the big ticket deals we've seen, we'll continue to see some of those as well.
And there's been quite a few eye-catching deals recently. The M&G have put its wealth platform up for sale, so Eccentric, so previously acquired by M&G, and Pollen Street Capital have acquired Mattioli Woods in a £400 million deal. Who are typical buyers for these sorts of transactions?
It's an interesting question. I think there's no getting away from the fact that the ability to consolidate and create value lends itself to private equity buyers. It's the kind of model that they like to go after. As you say, Mattioli Woods gone to PE, and I wouldn't be surprised to see M&G end up going to PE, whether that's directly or to one of the PE-backed consolidators. And it's certainly what we've seen ourselves on deals such as Saltus, where we acted for them. So they took investment from Preservation Capital to help drive their, accelerate, I guess, their growth. And also a couple of years ago, acted for Nucleus on its take private for 140 or so million by private equity backed James Hay. And of course, with that backing, Nucleus was unable to go on itself and acquire Curtis Banks. So definitely a lot of PE activity. However, Martin, it's not just private equity who we're seeing active in the market. There are also strategic buyers out there. So for example, we're active for one of the most well-respected and fastest growing platforms, Embark, on its 390 million acquisition by Lloyds. And that was very much a strategic acquisition for Lloyds, adding to its multi-brand portfolio and enabling it to deliver a market-leading, self-invested proposition for its customers, and also to reinvigorate its intermediary offering under Scottish Widows and really to relaunch its stockbroking business. So for them, a cracking strategic mix.
Becoming part of a large institution like Lloyds must have been quite a change for Embark, given its role as a disruptor. Have you any thoughts on that?
Yes and no. I guess that what it really did was mark a new chapter, a natural progression really, in what was a pretty stellar 8-year growth story under visionary founder and CEO Phil Smith. Over those 8 years, Phil and his team took what was a pretty humble pensions administration business, and by adopting a very tech-enabled, nimble, customer-centric approach, tied in with some strategic acquisitions, which are pretty transformational, and also taking strategic investment over that period from a select group of leading asset managers. They transformed that business very much into a fast-growing, diversified financial services platform, and one which was not only massively respected in its own name, but of course, which provides white label services to a lot of household names.
And I gather that you led a team that was lucky enough to be advising Embark on its sale.
We're delighted to have supported Embark all the way through its life, including on that sale and indeed continuing today. But it was very much a transaction which worked for both parties, customers really. For Embark, it enabled it to continue to accelerate and drive its proposition growth and service innovation for intermediaries with investment and support from Lloyds. And for Lloyds, it enabled it to deliver new capabilities to its millions of customers. So a great deal for both sides.
And I think we're still seeing some of that entrepreneurial zeal today with Lloyds supporting Embark as it develops propositions across the board, including ready-made investments. And you mentioned how there was this rapid period of growth over 8 years. How did the sort of speed of growth impact the sales process?
Not massively, because Phil and his team are very experienced and excellent operators. But as with many fast-growing businesses which take a lot of investment at different stages of growth, you can end up with investors of different vintages, with different drivers and different expectations, and that of itself can create interesting dynamics to navigate through on an exit. You've also got, because of the growth by acquisition, etc., you've probably got parts of the business which, as the model matures and you come to exit, are non-core and which therefore need to sit outside the transaction perimeter, as was the case here. And then of course, Embark, financial services business regulated by the FCA, as all of these platforms are. And consequently, you've always got to get FCA approval to the transaction, and that lends itself to a thread of thought which runs throughout these transactions, not only what's best for the shareholders, but also what's best for the customers. I'm blessed, Martin, that because there was no real overlap between Embark's activities and Lloyds' activities, that we didn't really have to worry about competition aspects. But I think that with increased consolidation and an increasingly interventionist CMA, that we're going to see that crop up with more and more of these transactions going forwards.
Thanks, Mark. That's a really good point. And it's really interesting to hear about your experience with Embark. And I know you're continuing to work with them and a number of other platform firms, so thanks.
My pleasure, Martin, my pleasure. And what about you? What are you seeing in the market at the moment?
Well, as you know, a lot of my work actually is more on the more operational side, so helping clients develop their product and technology capability. In fact, I did a deal recently with Embark as they were looking to invest in their long-term technology and service capability, to benefit customers. And in that project, they outsourced a range of services, technology and other, to FNZ, the end-to-end wealth management platform. And so the driver for those sorts of transactions, and we're seeing this quite a lot across the market, are economies of scale, efficiency in operations, stability and resilience in operations, but obviously crucially ensuring delivery of positive customer outcomes in the longer term.
And is it just the bigger players with the financial firepower who are investing in this stuff?
To a degree. I mean, obviously it's those larger firms that have the financial resources and capability to invest in sort of long-term strategic plays. But actually, we're seeing quite a lot of activity at different segments of the market. There are still new entrants coming in. The wealth management platform market still feels quite hot. There is a range of products being developed. clearly pensions and lifetime savings, but also into fixed term savings and other crossover savings products. So looking to provide a platform where consumers or their advisors can come and really fulfill a wide range of their financial kind of needs. Some of these new entrants are private equity backed, some are not, and also we're seeing different sort of strategies being applied into how people enter or grow in the market. Some very much focusing on differentiation by technology, and so I suppose we'd call those the wealth techs. But there's also a breed of business that are leveraging existing technologies and regulatory structures, and I suppose those businesses are looking more at the product development angle and the sort of ownership of the customer and the customer experience. So all in all, there's lots of activity, I think both at the sort of big players and in the smaller and growing side of the market as well. Certainly for me, a place to watch, and as a consumer it's great because there's loads of options on the market.
Yeah, no, there's definitely loads of activity going on, right? So as you say, definitely a place to be watching at the moment. Yeah.
Thank you.
Super, thanks Martin, it's great.